Okay, welcome back. Thank you for joining me for the third series of this chapter. We're going to be covering section 3 of chapter 9, Managing Your Investments, which comes right out of my book, Financial Independence, Getting to Point X. Before I jump into the details here, just take a minute or two and read this famous quote from Warren Buffett. Today, our topic of conversation is going to be qualified opportunity zones. This is also one of my top tax smart investment strategies. If you're fortunate enough to have large capital gains from any type of investments this year, then you may be in a position to take advantage of this tremendous tax break available to investors. Remember, the trick here is not just making the right investments, but doing them in the most tax efficient manner. So what is the purpose of a qualified opportunity zone? So let's take a look at this slide. An opportunity zone program was originally created to revitalize economically distressed communities using private investments rather than taxpayers' money. In return, the investor participates in these opportunity zones may receive potential tax benefits subject to certain restrictions and conditions, of course. So what are qualified opportunity zones? Back in 2017, as part of the 2017 Tax Cut and Job Act, qualified opportunity zones were created. And the federal government basically went out, spoke to local states and cities and said, you guys create a map of your areas that meet certain criteria that consider them to be underprivileged, either based on the average low income, high unemployment, and things of that nature. So they came back with 8,700 areas that they mapped out throughout the United States that have been called economic opportunity zones. So those are the areas that we have to focus on. And when you invest in a qualified opportunity zone, they always have to be in one of these 8,700 areas that are located on the map. So again, just like with Delaware statutory trusts, you need to be an accredited investor. I'm not going to repeat this here again, but you'll take a look here. This is the definition of an accredited investor. If you don't meet this qualification, bad news is you currently do not qualify to do an investment in a qualified opportunity zone. And what I would suggest to you is listen to this for educational purposes. When you do get into the position, hopefully this opportunity will still be available to you. So what are the tax benefits of investing in a qualified opportunity zone? Number one, in order to invest in this, you need to have capital gains that you generated from the sale of some other asset. And again, this is not just real estate we're talking about. It could be the sale of real estate. It could be the sale of a coin collection. It could be an old car that you owned. It could be a business that you sold. It could be virtually anything except for your primary residence, your home. So if you incurred a large capital gain and you're going to be faced with paying a high tax bill, then one alternative you have is you can invest just the capital gain. You don't have to invest everything like you do with a 1031 exchange. It's only your capital gain that would have to be invested. The first advantage to doing this is that the tax deferral process, you would be deferring the payment of the tax on your capital gain from whatever investment you sold, and you don't have to pay that tax until the fourth quarter of 2026. The due date to pay that tax would be April 15th, 2027. So that gives you deferral for almost 5 years. That's a nice incentive, especially if you could time the years where you're going to have a lower income. You could work with that to try to generate a much lower tax bill in the year 2026. In addition to that, the big savings to this is any money you invest in that qualified opportunity zone, that money, after you pay the capital gains tax on that in 2027, 100% of the money you pull out of that qualified opportunity fund will be completely income tax free. Not just the money you put into it, but every penny of gain that you generate upon the sale of that property will also be completely income tax free. The key here, though, is there's a 10-year holding period. So when these qualified opportunity funds are created, the intention is that that investment will have a life of 10 years or longer, because if the property is sold before 10 years, then you're not going to get the tax-free benefit that I just mentioned. So whether you sold stock, real estate, businesses, any type of investment, you'll be able to utilize that capital gain on a qualified opportunity zone. Here are some examples of the type of assets. Again, stock, mutual fund, real estate, excluding your primary residence. You sold some expensive jewelry, artwork, maybe some collectible cars. You name it, you could defer the tax and invest it here. A qualified opportunity fund is an investment vehicle typically organized by a corporation or a partnership, which must hold at least 90% of its assets in a qualified opportunity fund business. So how these have to be structured is very strict. I wouldn't attempt doing this on my own. Rather than going and trying to develop your own qualified opportunity zone, you really want to work with a plan sponsor that does this all day long. They have a team of lawyers, CPAs. They structure these things, invest in a qualified opportunity zone through a qualified opportunity fund. From the date of the sale of your appreciated property, you have a gain. Generally, you have 180 days to reinvest that money into the qualified opportunity zone to qualify for this special tax break. So to clearly illustrate the tax benefits of a qualified opportunity fund, I'm going to give you a typical hypothetical example here with an example on the following slide how this would work. So day number one, you sold your property for $1 million. Actually sold it, your gain is $1 million. That is 2022. You now have to reinvest that money within 180 days of the sale. In 2026, at the end of 2026, you're going to have to report that on your tax return and pay the capital gains tax at that point. 10 plus years later, once that property is sold, let's assume you invested the full $1 million into it, and that was your capital gain amount. That capital gain is not going to be taxed again because you already paid the tax on that in 2027. But now let's assume that that $1 million investment turned into $3 million. When you sell that investment in that qualified opportunity zone because it got liquidated, the full $3 million is now going to be completely income tax free. I think you can understand why so many accredited investors are taking advantage of this, because I'm not aware of anywhere in the tax law that's going to allow you to make an investment like this and get tax-free return on it at the end of it. So the potential major tax benefits here are avoiding paying capital gains tax altogether on any profit above and beyond your original investment, and also deferring the tax as well. To me, by far, this is one of the most attractive tax-free investment vehicles available out there. If you can take advantage of this, please do so. If you have any questions, by all means, call me, email me. I'll be happy to get on the phone with you to have a discussion. These are not simple tax matters, so I think further clarification is in good order. So the very many benefits here from a tax point of view also include these are considered passive income. Because it's passive income, if you have other real estate investment that are generating losses, you could offset passive income to passive losses. If you're in a lower tax bracket, the income you generate from your rental income activity could be subject to the Code Section 199A reduction. And what that means is 20% of your profit from your rental activity may not be subject to tax. Another big advantage here is that the underlying property, after you take a continued depreciation on that during your 10 plus year holding period, as long as you end up holding it for the 10 years and the property is sold, all of the depreciation you got the benefit of over the years on that qualified opportunity zone, that depreciation does not get recaptured. So not only are you avoiding paying capital gains tax on the gain, but the benefit you got from the depreciation while you held that qualified opportunity zone, normally that would get recaptured at a 25% tax rate. That also will be completely tax-free. Once again, guys, this is a tremendous tax savings opportunity. If you're in a position to take advantage of it, you should definitely consider doing it. So this is especially important to high net worth individuals. This is another benefit. So let's assume you're worth 20, 30, 40 million dollars. Let's hope you followed all the rules in my book and one day you accumulate that level of wealth. What ends up happening is upon your death, all of your assets are going to be subject to estate tax if you don't do the proper estate tax planning. Well, the nice thing with a qualified opportunity zone is the fact that it's an illiquid investment. And what that means is when they value that property on your date of death, there's going to be valuation discounts that apply. And what that means is it's a highly tax efficient asset to own as part of your overall estate tax planning strategy. So again, a lot of tax benefits here, a lot of which many people aren't even aware of. So got to put this in your list of ammunition to implement in terms of tax saving strategies. Our end game here is pay as little tax as the law requires by taking advantage of these things. Also, implement this as part of your estate tax planning strategy so you could also minimize your estate tax bill after you pass on and maximize the legacy you leave to your loved ones, whether it's your children or other people. So with that said, I hope you enjoyed this presentation along with the series of 3 presentations I provided you related to tax smart investment strategies and how to best manage your investments.